Are we on the brink of a financial meltdown? Experts share cautionary insights.
Stay tuned as we dissect the alarming trends in the stock market, inflation rates, and the whispers of a recession.
Welcome to Financial Insights in Minutes, where we dynamically summarize the day's key financial discussions.
We'll delve into insights from leading financial experts to unpack pressing market issues.
So, let's dive straight into today's featured videos. Today, we're exploring the intriguing world of market trends from David Lin's channel with Gareth Soloway, Chief Market Strategist at Verified Investing.
That's right. We'll roll up our sleeves and analyze the volatility in stocks, Bitcoin, and gold. It's going to be a roller coaster of financial insights. So hang on.
Let's get to the facts. Gareth suggests that the S&P 500's current patterns reflect those from 2007. What's that all about?
Exactly. Historical patterns tend to re-emerge because investor psychology essentially remains unchanged. If these patterns hold, we might see new highs, followed by a significant fall.
What's happening with the current market trends? Expert.
The S&P has dropped and rebounded, just like in 2007. If this plays out, we could see investors becoming overly optimistic, leading to a sudden downturn.
Now, let's talk about the Fed. What can we anticipate from their monetary policy, considering this?
If the Fed cuts rates, it often signals underlying economic issues. Historically, rate cuts have preceded market downturns, so this time may not be any different.
What's the scoop on Bitcoin in relation to these trends?
Bitcoin has been diverging from other markets, but still shows bullish consolidation. If we cross certain thresholds, we could witness a surge or drop. Nuance is key here.
What predictions does Gareth foresee for the immediate future?
Expect continued volatility. With the Fed's decisions on rates, investors should be prepared for sudden shifts that could shake up the financial landscape.
What about longer-term predictions, especially regarding a potential recession?
Historically, rate cuts suggest trouble ahead. We might be facing down the barrel of a recession, especially if unemployment rates climb.
Wrapping things up, what's the big picture for our viewers?
Stay cautious. The patterns suggest we're in a critical phase. The Fed's actions will dramatically influence the market's trajectory in the upcoming months.
And as always, we want to hear from you. How do you think the Fed's next move will impact the market?
Leave your thoughts in the comments below. Your insights could light the way in this financial fog.
Today, we're navigating the complexities of economics and finance from Eurodollar University. Buckle up as we explore interest rates and their real implications for the economy.
We'll decode what's really driving interest rates down and share some intriguing theories about government manipulation. It's going to be an enlightening ride.
What's the essence of today's discussion?
The core thesis reveals that low interest rates indicate deeper economic troubles, rather than manipulative government actions. It's all about understanding the real underlying conditions.
Let's tackle some common misconceptions about interest rates. What do economists often get wrong?
Many mistakenly believe interest rates are solely a byproduct of government manipulation. In reality, they reflect broader market conditions. It's like reading a weather report and blaming the paper.
What does the persistent low-rate environment suggest for growth and inflation?
It indicates low growth and inflation expectations. This environment reveals that not everything is well beneath the surface.
And how does Treasury issuance factor into this?
While Treasury actions and issuance shape some perceptions, it's actually the market conditions that dictate responses to these changes, not just the numbers.
Let's discuss the hot topic. What about the stealth quantitative easing theories?
Supporters argue government actions mimic quantitative easing outcomes. But according to market principles, the reality is deeper. It's about the economic conditions instead of just policy manipulations.
Looking ahead, what does the future hold for interest rates?
We might see rates remaining low alongside declining economic indicators. The expected traditional relationship may not apply as market dynamics shift.
What's the prediction on new policies?
New policies will shape future growth expectations, but expect some volatility as markets adjust to emerging realities.
To sum it all up, what's the takeaway from today?
Understanding the true drivers behind interest rates is essential. As we navigate, we must focus on genuine economic indicators rather than just headlines.
As we wrap up, we want to hear from you. How do you see interest rates evolving?
Join the conversation in the comments. Your insights could shape future discussions on economic trends and interest rates.
Today, we're diving into the markets as they brace for Nvidia's big earnings report from Trade Brigade. The stakes are high for this tech giant.
Absolutely. The markets are fluctuating, and we've got essential charts to analyze. Stick around as we uncover the possibilities and what this could mean for future trading.
What's the main thesis today? Why all eyes on Nvidia?
The crucial insight is that markets are at a crossroads, teetering on major support levels while everyone waits for Nvidia's earnings. The outcome could significantly influence market directions.
What key highlights should traders note from the economic calendar?
Today's calendar appears slow, but keep an eye on consumer confidence at 10 o'clock. This could ignite some volatility.
What's the market sentiment?
Traders are clearly cautious. With Nvidia set to report soon, there are concerns about how its performance might sway investor sentiment.
How vital is Nvidia's performance for the market?
Nvidia isn't just another stock. Its performance sets off a ripple effect across tech stocks. Missed earnings could result in serious trouble.
What potential market reactions should we prepare for?
A positive surprise could send the market soaring, but conversely, a miss could trigger a steep sell-off.
What are the predictions post-Nvidia earnings report?
Expect substantial market shifts. Smart repositionings by investors could alter the entire landscape.
Could we see market pullbacks?
Absolutely, especially if Nvidia's report doesn't meet expectations. Key support levels may be tested and even breached.
What should traders take away today?
Nvidia's earnings are critical. Understanding these dynamics is key to navigating potential market traps.
As we close, what should viewers consider as strategies?
Drop your strategies in the comments. Let's see how others are preparing for these earnings.
Today on the Julia LaRoche Show, we're diving into the recent downward revision of jobs data and its significant implications for the economy.
Yes, Dr. Lacy Hunt is here to unpack this complex issue. His insights are always invaluable, and this is a conversation worth tuning in for.
So what's the critical thesis here? Why is this revision so important?
This downward revision isn't just a glitch. It reveals systemic issues in how we measure economic health. It raises questions about how many other figures may be overstated.
What does the jobs data revision signify?
This downward revision isn't a trivial detail. It undermines confidence in our economic recovery, having overstated personal income and skewing perceptions of economic health.
And its impact on broader economic indicators.
Exactly. Overstated job figures lead to inflated gross domestic product and gross domestic income numbers, indicating serious discrepancies in data accuracy.
What's at stake for policymakers?
Policymakers are making decisions based on flawed data, which could lead to worse economic outcomes.
What does Dr. Hunt foresee?
He predicts a continued deterioration in economic metrics as the fallout from the jobs data revision unfolds, forcing a reevaluation of Fed policy decisions.
What conclusions should we draw?
The jobs data revision exposes significant flaws in how we gauge economic health. It's essential for everyone to stay vigilant and informed.
So the big question remains, how do we address these data issues?
That's the million-dollar question. Experts call for improved data collection and reporting methods to avoid such pitfalls in the future.
As we finish up, we want to hear from you. How do you think this will impact the job market?
Drop your predictions in the comments. Let's discuss this complex issue further.
Welcome to Thoughtful Money. Today, we're navigating some choppy waters regarding interest rates and our economy. Insights from Thomas Hoenig, a former CEO of the Kansas City Fed, will guide us.
Absolutely. Hoenig unpacks the implications of recent monetary policies and the economic tides that lie ahead. So let's hoist the sails and dive into his insights.
What's the main thesis from Thomas Hoenig's discussion?
Hoenig emphasizes the need for caution in cutting interest rates. Prioritizing inflation control while managing risks of excessive easing is crucial to avoid future economic storms.
What's the scoop on how low interest rates affect debtors?
Hoenig explains that maintaining low rates shifts the burden onto savers while benefiting debtors. This creates a subsidy favoring one group while sidelining savers.
What's the balance between inflation and employment that Hoenig discusses?
He warns against prioritizing employment over inflation stability, as an imbalance could lead to significant economic troubles in the future.
How does fiscal policy fit into this economic picture?
Hoenig stresses that fiscal and monetary policies must work together but remain independent. Over-reliance on either can spur unwanted inflationary pressures.
What alarm bells does Hoenig ring regarding wealth inequality?
He cautions that today's policies enhance the wealth divide, leaving younger generations stranded without opportunities for asset accumulation.
What predictions did Hoenig make regarding the economy?
He believes that continued easing without restraint could trigger a resurgence of inflation, which we must be wary of.
What about future economic turmoil?
Hoenig predicts increased public frustration may drive urgent calls for fiscal accountability, highlighting the necessity for coherent policy solutions.
What's our takeaway from this discussion?
The overriding conclusion is clear. Policymakers must urgently balance inflation control with economic growth strategies, or we risk sailing into turbulent waters.
Curious about what strategies can be employed. What are your thoughts?
Let us know in the comments. It's a critical conversation on steering our economic future.
Welcome back to the Technical Traders. Today, we're diving into the fascinating world of stock chart technical analysis. Are you ready to navigate the currents of Nvidia, Tesla, Amazon, and Apple?
Absolutely. Our market analyst breaks down crucial insights into these stock patterns that could significantly impact trading strategies. Buckle up, because we're just getting started.
What's the core takeaway from today's analysis?
The main thesis emphasizes that current market movements and stock patterns for heavyweights like Nvidia and Tesla are at pivotal turning points, potentially leading to future rallies or pullbacks.
What's happening in the current market?
Well, the S&P 500 has experienced a slight downward trend, while the Nasdaq is holding in a bullish flag pattern. It's a mixed bag.
How about Nvidia? What's on the charts for them?
Nvidia is showing potential with a positive reaction at its 5-day moving average, indicating a possible breakout that could yield increases over 20%.
What about Tesla? Are they maintaining their cruising speed?
Tesla is still struggling with lower highs, but there's hope. The chart suggests it could break out of that pattern and rally.
What's on the horizon for tech stocks?
If key players like Nvidia and Tesla rally, we could see the broader market respond positively, boosting overall investor sentiment.
How about the broader economic landscape? What shifts should we watch?
There's potential for money to rotate from bonds to stocks, indicating a bullish outlook. Let's see how investors react to upcoming changes.
What are the crucial takeaways?
Tech stocks like Nvidia and Tesla are approaching critical moments for potential shifts in the market. It's essential to stay tuned as these stocks play out.
What should traders focus on moving forward?
Pay close attention to those moving averages and flag patterns. They will guide your next moves in the market.
As we close, we'd love to hear your thoughts. What do you think the future holds for these tech stocks?
Drop your predictions in the comments. Your insights could lead to the next big trading strategy.
Welcome back to Figuring Out Money. Today's big question: are the pieces of the economic recession puzzle aligning? We'll delve deep into S&P 500 sectors and what they reveal about our economic future.
That's right. We're breaking down indicators, signals, and what they mean for your investments. With Michael Silva at the helm, it's time to navigate today's economic discussion.
What's the main takeaway from today's analysis? What should investors focus on?
Today's core thesis suggests that the S&P 500 sectors are sending warnings about an impending recession. Michael Silva argues that the market often leads the economy, and right now it's raising red flags we can't ignore.
What insights do the 11 S&P 500 sectors provide?
We're seeing sectors like consumer staples and healthcare performing exceptionally well, indicating that investors are moving towards more stable, less risky assets. It's a classic sign of a jittery market.
What are the implications of the Fed's potential rate cuts?
Absolutely. With a 71% chance of a rate cut, the Fed appears to be preparing for adjustments. Historically, these cuts often occur during troubled times, hence caution is warranted.
Why is understanding past market corrections important for investors?
Past trends indicate that market corrections typically follow peaks. Recognizing the gamma flip line is crucial. It helps identify the best time to buy or hold positions amidst volatility.
What are the predictions concerning a potential recession?
The signs are evident. If current economic data continues to dip, we could swiftly transition from optimism to caution, leading us into recession territory.
How might economic policies influence this situation?
Policy changes could be pivotal. Investor confidence heavily relies on Fed guidance. Keeping an ear tuned to their statements could provide crucial insights into market direction.
What are the big insights for investors as we conclude?
Ultimately, the S&P 500 is sending vital signals. Investors need to remain vigilant and adaptable, ready to respond as the economic landscape unfolds. Navigating these waters requires keen observation.
We want to hear from you. What do you think about the current economic climate?
Drop your insights in the comments below. Together, let's piece together the economic puzzle and see where it leads us.
Welcome to Blockworks Macro. Today we're diving into the currents of our economy with a special lakeside discussion featuring Jim Bianco, founder of Bianco Research. Get ready, because there's a whale of a market story to uncover.
Absolutely. We'll explore the market's recent reactions, inflation trends, and what a deficit president means for our economic future. There's a lot to digest, so let's reel in those insights.
What's the crux of today's conversation?
The key thesis is that regardless of the next president, a significant deficit is likely to persist, heavily influencing our economic landscape and market behaviors.
Let's discuss the recent economic reports. What transpired?
Initially, economic reports were troubling, but as the month progressed, we saw a rebound in retail sales and declining inflation, which helped restore some market confidence.
What do shifts in market sentiment indicate?
Exactly. Recent shifts show that positive economic news raises worries about inflation, while negative news now triggers recession fears. It's a complicated dance.
What's the Fed's interest rate forecast?
Analysts predict at least a 25 basis point cut at the next Fed meeting, especially with crucial discussions planned for the Jackson Hole event. Can they manage the narrative?
What predictions are on the table?
The buzz indicates that Powell's remarks at the Jackson Hole meeting will be crucial. Markets are betting on multiple rate cuts next year, but uncertainty looms.
What are the key takeaways from this economic dance?
Jim emphasizes that persistent deficits will shape future strategies regardless of who occupies the presidential seat. It's a tightrope walk for policymakers.
And before we go, we want to hear from you. How do you think the upcoming elections will impact the economy?
Drop your predictions in the comments below. It's your turn to steer this economic debate.
Today's discussions have armed us with crucial awareness of the volatile state we find ourselves in.
Indeed, both Gareth and Dr. Hunt highlighted significant economic risks ahead while offering diverse strategies for mitigation.
The tensions between inflation control and economic growth remain a central theme among our experts.
Thank you for tuning in to Financial Insights in Minutes. Stay prepared and informed as
Remember to like and subscribe. Thanks for watching Financial Insights in Minutes for August 27th, 2024. If you found this time-saving content useful and want to support the channel, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.